How to increase equity in yours or your client's business. Probably sounds like a pretty simple question at the outset, but I'm going to challenge you to think this through, and of course I'm going to demonstrate you in kind of a simple way at first exactly how you would increase equity in yours or your client's business. We're looking at a balance sheet. As you can see, there's nothing in here. This is a sample file I've used in other instances before. I've gone ahead and deleted all the transactions so that we're starting with a blank slate. I started a business. I just opened up my doors. Maybe I don't actually have doors because maybe I'm an online startup type company doing everything virtually and remotely, whatever it is. The bottom line is somehow I'm going to have to contribute value into the business, right? I'm going to, perhaps at the outset, we spend money out of our own pockets, so it doesn't really affect the business directly. And then eventually we get a corporation formed or an LLC formed, and we open up a bank account. So how do we increase equity in a business? Well, one way, the easiest, the simplest example is I put money into it, right? If I increase the cash, if I put money into the bank account for the business, the journal entry is debit cash. Debits increase assets, unlike what the banks have trained us to think. And we credit the equity account, which is an increase in equity, right? So one way to increase the equity of a business is to simply put money into the business. Let me give you a demonstration. If I go to a bank deposit, and I'm going to deposit into my Wells Fargo operating, we'll do it today. And over here, where are my equity accounts? There they are. So I'm going to say shareholder contributions, right? And let's say we start the account off with $10,000. Save and close. No class. I have no class. And we change the report dates to all dates. And there's my $10,000, right? Debit to cash. And my $10,000 credit to equity. So one way to increase equity is to deposit money into the business. Very simple, right? Because what did I do? I added value into the business. If you remember, if you watched the video from my overview, that's what the equity section of the balance sheet represents. It's how much is the business worth today. And it is today. The balance sheet is always looked at as of a particular day, usually today. We tend to run it at year end, so that means that we're looking at the balance sheet as of December 31st. But the balance sheet is a snapshot. It's a moment in time. What do things look like today? These, of course, are balances that represent the permanent accumulation of everything that went into and out of the accounts, right? Unlike profit and loss accounts where money kind of goes in and clears out at the end of whatever the fiscal year is, usually a calendar year. So this is a permanent accumulation in here. So that's the book value of the business, or the net worth of the business, is the total equity. In this case, nothing else has happened. I just put $10,000 into the bank. My business is now worth $10,000. What else could happen when we're starting the company? Maybe we do need some startup capital, right? So another way that money might come into a business, cash anyway, is if, let's say, the bank loans me money. Right? So I'm going to give you a second to think about this. If I borrow money from the bank and deposit that money into the bank account, will that increase the equity of my business? And if you don't know the answer to this, you should definitely go back and review my bookkeeping fundamentals with cloud accounting applications. It goes over your debits and credits, and for that matter, what accounts are affected, where and when and how. It goes over that based on based on your true accounting, debits and credits. So if you haven't come up with the answer yet, go back and review that course, and then you'll definitely know the answer. Let's take a look. I'm not going to answer the question. I'm going to just record the deposit, right? So that's what happens. I go to the bank and say, hey, can you loan me money? The bank says, yeah, fill out a whole bunch of forms, send us a whole bunch of information, sign off that you'll personally guarantee it, and we'll be happy to lend you the money. So I'm going to put in another deposit for $100,000. Right, we're going to borrow $100,000. But what's the account that's going to go here? When I put my own money in, it was an equity account. It was shareholder contributions, right? But here it's a liability account, isn't it? It's going to be loan payable, Wells Fargo. right? And I will create that account. It is a loan, which is another current liability. Loan payable. Save and close. Save and close. I am sure that I want to save this transaction. Now what have we got? We've got $110,000 in the bank, but now I've got a liability of $100,000. I have not increased the equity of my business, even though I put money in. Because in this case, the money came from a different source. It didn't come from me. It wasn't contributed into the business. I have to pay it back. So that's a liability, right? And now you can start to see the picture in terms of the formula about how assets are equal to the total of liabilities and equity, right? Total assets right now is the total cash in the bank, $110,000. Where did that cash come from? $100,000 was a loan, that's in the liabilities, and the other $10,000 was contributed capital. So I get my $110,000. So borrowing money does not increase the equity of a business. Contributing money into the business does, however, increase the equity. Now, let's make a buck. Let's invoice somebody for something. So we'll go into invoice our customers. I'll make up a new customer for this. I had sort of real estate customers as an example. We'll add in some customer. Product or service. Let's do subscription sales. Okay. And we'll say $24 sounds good. I'll say save and close. Now, we get accounts receivable of $24. My total assets have increased. Will this impact the equity account or no? I'm going to give you another second to think about this. And again, the best way to understand this is to think it through in terms of the debits and credits. I just posted an invoice. I debited accounts receivable. You've got that part sitting right in front of you. We increased accounts receivable by $24. What did I credit? The credit goes to an income account, right? I've increased income. I'm going to run my profit and loss. We'll run it for all dates. That's interesting. Oh, looks like I used an item that was linked to an expense account. So we have a negative expense instead of income. Let's go fix that real quick. Oopsie. That was my subscription sale. So we're going to edit this. And we are going to say, I sell this service, subscriptions, sales. We'll just call it sales or product income. I don't care about the specific sort of nuances for this purposes. QuickBooks Online is also going to ask me if I want to update this account in historical transactions. So I'll say yes, save and close. Now let's go look at our profit and loss, and it should make just a little more sense. And there it is. So we have sales or product income for $24. And that leads us to net income of $24. So I really want you to understand how this is flowing. I have an invoice. I debited accounts receivable. I credited sales. Nothing there has impacted the equity account directly. However, what then happens is we look at the rest of the profit and loss for the period, right? Which in this case, we're just looking at all dates. So it's for all time. And what happens is when I have income of $24 and no expenses to go against it, that means I have net income of $24. And here's where it gets into the flow to equity. Because what now will happen is QuickBooks will post a closing entry. It does this automatically. That takes whatever the net income is for the period for which you're running the balance sheet, and it closes out to the equity section. Let's run the report. And let's go down. And sure enough, we see that the net income is now $24. That's the net income closing from the P&L. So it doesn't come directly from the fact that we invoiced somebody for $24. It comes from the fact that my net income for the period is $24. And that's, in fact, how we balance. Because otherwise, I'd be out of balance. I increased receivables, right? It has to balance out somewhere on the balance sheet. And that's how it does, because that receivable produced the only item that goes on the profit and loss as of right now for $24, and that increased my net income, which means that increased my equity. So another way to increase equity on the balance sheet, and I'll spoil it for you, the best way to increase equity on the balance sheet is to make money, is to earn a profit. So now if you went back to the overview video and you reviewed my comments, now it should make complete sense. What I was talking about when I said really the way to manage a company properly, in my opinion, is to manage it from the equity section of the balance sheet. Because in order to build equity, the best way to build equity is to make a profit. So it builds into that. When you're managing from the equity section, built into that management process is the assumption that we have to make a profit, that we have to make money. And as I mentioned in that video, it goes without saying, every business that's a for-profit business, it's a no-brainer. Every business wants to make as much profit as possible. And now you've seen the perfect example of why. Because the more profit I make, the more I can build equity in my business. So now I have equity in my business of $10,024. So let's see what happens if I make a payment on this loan. Let's say I make a principal payment on the loan. Let's go write a check. We'll write it to Wells Fargo. Add them in quickly as a vendor. So let's say, I put the $10,000 in, and they were good enough to loan me the $100,000. Let's use the $10,000 to pay off part of that loan. $10,000 in the account. Loan payable, Wells Fargo. So what's going to happen? I'm going to reduce cash. I'm going to reduce the loan. Any impact on equity? Remember, equity was $10,024, or the equity was $10,024. That's correct. So let's see how this impacts our balance sheet. I'm going to save and close. And the answer is no. Of course, there's no impact on equity, because what did I do? I reduced my cash by $10,000, and I reduced my liability by $10,000. I now only owe the bank $90,000. So paying off loans doesn't increase equity, does it? Let's see. What else can I do to increase or decrease or affect equity? Let's pay for an expense. Let's go pay for some office supplies. So we'll record an expense. And we'll pay Staples on a debit card. Office supplies. And we'll spend $10. Save and close, yes. I reduced my cash by another $10. But what else did I do? I incurred an expense, didn't I? So what does that mean? I had the income of $24, but now I've got an expense of $10. So I've no longer made $24. I've now only made $14. So previously, we had a $24 closing entry to the balance sheet to reflect the net income. We've just actually reduced that amount from 24 to 14. $14 is our net operating income. So we've just effectively reduced our equity, haven't we? So paying for expenses reduces equity. In that regard, it's a bad thing, right? It reduces the value of my business. Now, granted, it's what we have to do, right? We have to, in order to stay in business, we got to pay for things. We got to pay people. We got to pay, and that just explains everything we pay that ever gets recorded as an expense. And we've also seen the impact of everything we do in terms of incurring income, right? Speaking of, we invoice somebody, but it's in receivables, right? Let's go collect the $24. And hopefully by now you can put it together whether or not this is going to have any impact on the equity of my business. Let's go receive a payment. And who is my customer? It was some customer, wasn't it? Some customer. All right, let's check him off. He's paid in full. We'll put it right into the bank account because it's the only thing that we're getting paid here. So I've gotten paid now, right? So my cash went back up, but my receivable went down. I reduced an asset and I increased an asset. So that's a wash right there. So no impact whatsoever on equity. I increased the equity when I earned the net income. Getting paid on the invoice has no impact on equity. And this, by the way, is an example of why it's so important to run your business on an accrual basis, even if you're a cash basis taxpayer. The only time you run cash-based reports is when you're going to go pay your taxes and you need to have the right type of report to figure out what you owe. Okay, so getting paid a receivable, collecting the balance that my customer owes me, no impact on equity, right? It impacted the equity when I earned the money, when I posted that invoice. That's when it impacted equity. That's accrual basis accounting, and that's the right way to analyze your business. It has to be analyzed on an accrual basis. So, expenses reduce equity, income increases equity. Now, ultimately, we would love to get this liability paid down. But keep in mind that what you've seen is that paying that liability down does not improve my equity position because it's reducing my bank balance. Now, here's a tricky one. Let's say I paid this loan down out of my personal funds. Let's say I said, you know what? I don't want to pay the interest on this loan. By the way, the interest that I'm going to get hit with on the loan, of course, is going to reduce my equity, right? Because that's an expense. Expenses reduce equity. Income increases equity. It's that simple. That's the function of the P&L. Increase income, my net income goes up. Increase expenses, my net income goes down. Increase income, my equity goes up. Increase expenses, my equity goes down. It's just that simple. So the best way, really the only way in the end, to increase equity while maintaining a healthy business is by earning a profit. If I have to keep putting my own money into the business, that business is only going to last so long. Presumably, I only have so much money I can invest into the business. And if eventually the business doesn't take off and start making money on its own, then it doesn't make sense to keep that business going, right? So let's say I take money out of my personal funds and pay off that loan. I'm going to do it, and then I'm going to show you the impact, and then I'm going to explain it. But while I'm doing this, I want you to think about what you think is going to happen to equity here. I'm going to pay off the $90,000, but it's coming out of my personal funds. It's not coming out of the bank account. So let's book a journal entry for that. Okay, so we're set. We're paying down a liability. We're reducing a liability, so that's a debit to the loan payable Wells Fargo. Debits decrease liabilities because credits increase liabilities. What's the other side of the entry? If this is coming out of my personal funds, if I'm paying something out of my pocket on behalf of the business, what am I doing? I'm effectively contributing money into the business, aren't I? So it's another shareholder contribution. Paid off loan from personal. So is that going to increase the equity in my business? You bet it will. Because what I effectively did was the same. It's the same as if I had taken $90,000 out of my pocket and put it into the bank account. That right there would have increased the equity by $90,000. Then turning around and writing a check out of the bank account for $90,000 and paying off that liability would have had no further impact on equity. My equity is now $100,014. But here's the problem. So that sounds good. It sounds like great. I've got a business that's worth $100,014. But keep in mind where all of that came from. You know, on the surface, if you're just looking at the balance sheet, that might look great because you say, oh, got a lot of equity in the company, right? The company has a lot of equity. But you have to consider where it came from. And that's where the statement of cash flows comes in. So we're going to take a quick look at the statement of cash flows. And you're not going to find it in recommended because so few people look at this report, and yet it's probably the most important one if I had to pick one. So let's go to, let's see if it's in business overview. There it is, statement of cash flows. Perfect. We'll run this for all dates. And I'm not going to get too deep into this now. I talked about it at a high level in the intro video, which if you haven't figured out by now, you really need to actually watch that intro video because there's information in there that obviously I'm referring back to that you'll need to understand for context. But what's happened here is the only cash flow that came from my operating activities was the net income of $14. I earned $24 and then I had to pay for office supplies. So net cash flow from operations was just the net income. I got my $14, right? But the financing activities is me putting money into the business. I've put in a total of $100,000, the initial $10,000, which we used to pay off the line, and then the subsequent $90,000, which got into the business by virtue of the fact that I paid the $90,000 out of my personal account and used it to pay off that loan. So in effect, I had contributed another $90,000 into the business. So this is what I was talking about in the overview video, why it's so important to understand this stuff, because now you can see this is not a healthy company. If I only looked at the balance sheet, it might look healthy because it's got a big equity balance, right? But when you look here at the statement of cash flows, all of a sudden you see, oh yeah, but most of the equity came from the owner contributing money into the business, which raises questions as to whether or not this company has an ability to continue as a going concern. Right? Eventually, the cash flows have to come from operating activities. That's the name of the game here. So this, my friends, is why it's really important to run the business from the equity section, and the strategy has to be to build that equity of the company. But then you have to look at other areas. In other words, we can't just build equity of the company by contributing our own money into the business. We need to build equity of the company by actually earning a profit. It's so important. And then, beyond that, retaining that profit. In other words, if we spend everything we make, then there's going to be no money left in the business anyway. We're not going to, because distributions come out. Let's take a distribution. Let's write a check. I'm going to pay myself. And this goes out shareholder distributions. I'm going to take 50 grand out of the business. And we're going to save and close. And then we're going to run the balance sheet. Now I only have $50,000 in the bank, and there it is. So taking distributions, of course, reduces the equity of the business. I'm pulling money out of the business. So that reduces equity. So that's the problem that most people have, because I can earn a profit of, I'll show you an example. Let's go post an invoice. This time let's earn a lot more money. Some product I sell for $150,000. Right, I just want to get a big number recorded in there for some customer. Save, yes. Okay, now notice net income went up to $150,014 because I just added $150,000 to my net income by earning that money, and I didn't spend it, right? So I've retained it, right? We have it here in the accounts receivable. Let's go get paid. And you've already seen that getting paid is not going to have any impact on equity, because it basically just reduces the receivable and puts that money into cash. So now I have 200 grand in the bank. We're starting to look a little better. Let's run the statement of cash flows real quick. I always have trouble finding that one on here. We got to go to not management reports. Let's go to all reports, business overview. Now we're looking a lot better, because notice my operating cash flows are now $150,014. So that's looking a whole lot better, right? And then effectively I put 100 grand in, took 50 grand out. So I'm left with 50,000 that I put into the business, and the rest of the equity came from my operating activities. So now the company's looking a whole lot healthier, right? How do you want to manage the business now? Do you want to manage it by the profit and loss, or the formula in the profit and loss, or do you want to manage it by the balance sheet and the statement of cash flows, right? Because remember, the profit and loss information flows over into the balance sheet. So I already have the net impact after everything's said and done in the balance sheet reflected there. So how do you want to manage the business? Which reports do you want to use, right? So now you have hopefully a good sense of what increases equity in a business. If I go back to my balance sheet now, and again, we'll run it for all dates. Let's see where we're at. Right, this tells me for the date range, this is the net income I earned, right? And I can look back up at the balance sheet and see, where is all that money? I still have a lot of it in cash. Because here's the other thing. I could buy some equipment, and maybe that equipment's going to help me earn a lot more money. And we're going to get into some ratio analysis in this course, which is going to show us exactly what that looks like and how we can look at that. So let's say for right now, we invest, right? This is an investing activity. We're going to invest money. we're going to write a check to Machinery Incorporated. I'm very original with these names. And we're going to put it into a fixed asset. And this is going to be, again, a fixed asset. Machinery and equipment, save and close. And let's say we spend $25,000 on that. So what happens? Did that increase equity? Hopefully you figured out the answer to that already. It doesn't, because I took money out of my bank account and I put it into a fixed asset. I've now invested money into my business, right? So it's circular in terms of how it shows up on the balance sheet. Again, money out of one asset and into another. Absolutely no impact on equity, right? Now, that's not good or bad necessarily. It depends. Like I said, the machinery will hopefully help us generate income. So the reality is, now I'll give you just a quick example, and then we're going to wrap up this lesson, because I think you're getting the picture now. How do I increase equity? Ultimately by earning a profit. That's the way we need to increase equity, is by consistently earning a profit, and then investing our cash wisely. Get rid of the liabilities, because those liabilities produce an expense in the form of interest, and expenses reduce equity, right? So we want to keep those liabilities to a minimum. We don't want to borrow money, and if we have to borrow money, we want to pay it off as quickly as possible, right? The more you carry debt, the more it costs you and decreases equity. So the debt in and of itself doesn't increase equity. I don't increase equity when I get the money into the bank account, because it's offset by the liability. But as long as I carry that liability on my books, I'm going to get hit with interest expense month in and month out. And that expense, the interest expense, does decrease equity. So debt obviously is a very unhealthy thing for a business. And I qualify that by saying that obviously in some cases, we incur the debt because incurring that debt gives us the capital we need to invest in the business. Maybe we had to borrow the $25,000 to buy this machinery and equipment. Bottom line is, how much of income is this machinery and equipment turning over? And that's a ratio we're going to look at. It's called return on assets. So if I look at that right now, what's my return on assets? I'll run my profit and loss. I'll just run it for all dates. And my net income is $150,014. Let's get up a scrap sheet here real quick. All right, net income, $150,014. Okay, back to QuickBooks. Let's run my balance sheet again. Oops. Okay, balance sheet. I have machinery equipment of $25,000. M&E. So what's my return on assets? It's my net income divided by the assets. That's a 600% return. That's 6 times. That's good. That's really good. Assuming this were actually a real business and this is what the numbers look like, then that would look really good. It means that for what we've invested in our equipment, which presumably our equipment is being used to turn over income, we're able to use the $25,000 that we invested and turn that $25,000 over 6 times. That's what this ratio indicates. It's called ROA, or return on assets. So when you're looking at a client's books, if you want to really blow them away, you can run this kind of a scenario and look and see, what are they spending on assets? All the cars they buy, if I buy cars for the company, it's because those cars need to be driven by employees who are going to help drive income, right? Maybe I'm paying for those cars for my sales force to go out there and call on clients, whatever it is. The idea of having fixed assets on the books is we invest money into these things because the assets that we invest money into, that's why it's considered an investment, is that investment's going to go to work for us and it's going to help us churn income. And that's what we need to do. We need to invest in the machinery and equipment so we can generate the $150K in income, and that gives us a really nice return on assets. Now, it could have gone the other way, right? It could be that we spent $25,000 or we spent $150,000 on an asset and only earned $25,000, which means this ROA is going to be something less than 1, which is not good. And then, of course, determining what's good or bad. There's two ways to look at that. One, how does it compare with your industry average? That's not my favorite metric, though. My preferred way of looking at it is to compare ourselves with ourselves. What was our return on assets last year versus this year, last quarter versus this quarter, the same quarter of last year compared with the present quarter? So doing comparative analysis, comparing ourselves to ourselves based on time, that to me is the best metric, because that indicates whether or not I'm improving. I don't care what the industry is doing necessarily. If I keep improving, whether or not I'm better than the industry average now, I will eventually get better than the industry average, as long as the trend that I experience is one of continued improvement. That, my friends, is what this is all about. This is where I want to encourage you to start understanding what the equity section of the balance sheet really means and how it's increased, because then we're going to, from there, look at all the information. And I gave you just one example for now, kind of a little foreshadowing into what remains in this course of what this is going to look like and how we can start using this information to provide incredibly valuable information to our clients. As always, if you have any questions, check the little form on the sideline from Smartsheet where you can fill in your questions and send them in, and I'll get you an answer as soon as humanly possible. Thanks so much for watching. As always, I hope you had some fun and learned something along the way. I hope you're having an absolutely fantastic day, and we'll see you in the next lesson.